Recently, the SBA just changed the rule to where loans under $1 million have no SBA fee. For funeral service, we like to see a leverage ratio below 5.5 times, meaning that we're comfortable with the amount of debt you have compared to the amount of net operating income you have.
Welcome, everybody, to Take It to the Bank. I'm Ryan Thogmartin. I've got my friend Tim Bridgers, Live Oak Bank. This is such a dope episode because the information in this episode, we've been talking about this back and forth over the course of a few months that we've been building this out. But I want to know everything there is to know about loans for 2024. And so where I want to start is I need you to break down for me the difference between an SBA loan and a conventional loan.
Absolutely. And those are two very important aspects of, a business and understanding those, because you need to understand how to strategize. We talked about that earlier.
Mm-hmm.
A few characteristics of the SBA loan, and then we'll go into conventional. Recently, the SBA just changed the rule to where loans under $1 million have no SBA fee. So maybe besides a small packaging fee, technically below $1 million, if you have an acquisition or a loan for a renovation or anything for your business under $1 million, you technically can get that fee free.
Wow.
So then you're just looking at interest rate. The cool thing about SBA is it's guaranteed by the government. 75% typically of the loan is guaranteed by the government. So that allows the bank to be a little bit more comfortable in financing maybe a younger borrower, right? Or even an established borrower. It helps the bank get comfortable with the terms that the SBA is requiring them to give because of that guarantee. So it makes a difference. So what are some characteristics of the SBA? Well, the SBA will finance both goodwill and real estate in one transaction. So you don't have to worry about this loan to value. And the real estate for an SBA loan is really determining how long you pay it back. The more real estate you have in the SBA loan, the more time you have to pay it back. No real estate in the SBA loan, you got 10 years to pay it back. It's real simple. And 10 years is above average. So it provides simplicity and access to capital for businesses to expand and grow.
And by real estate, you're just business real estate.
Just business real estate.
Okay.
Yep.
That could be retort, buildings.
Yeah, the fixed assets of the building and fixed assets. So, really, really good for a new or existing owner to use that. Equity is another characteristic of SBA that typically is a little more lenient than conventional, right? So for a first-time buyer, a first-time buyer should prepare for 10% equity in the transaction. And that equity with SBA can be satisfied in multiple ways. It could be satisfied with all cash from the borrower. It can be satisfied from all seller carry, which is huge, right? Think about if you work for a firm for 20 years and you've been a funeral director, you have a family, you haven't been able to save, and the seller can hold your 10% and satisfy the equity requirement. You're essentially getting the business with no cash in it, okay? Or it could be a combination of two. So really, really flexible. And I will tell you this, if an individual has experience, a licensed funeral director who has experience, has good credit, has good character, and the business cash flow is strong, we can get you an SBA loan to buy that business. Don't ever assume you can't get in. That's what's great about the SBA. Mm-hmm. Now, if you're a more mature borrower and you own several rooftops and you're looking to grow, SBA is also great for you because if you have 10% or more equity in your business, you might could get that next loan 100% or close to it. The bank has a little discretion in that, but that's great. That means you can grow your business without draining your business bank account. And so for either one, SBA is great. Longer than average terms and more flexible equity. And then when you think about conventional, right, that's something that most people are more accustomed to. They go to the local bank. Sure. They leverage their real estate to get some working capital, that kind of thing. But you got to think about what conventional is compared to SBA. It's not backed by the government. So the bank is taking on the full exposure. Mm-hmm. So the bank is going to be more strict and it's going to be more regulated by the Fed. So there's going to be things like, the banks are going to be regulated on how much they can finance of the real estate value, right? So typically we're around 75 to 80% of the real estate value is what we'll give you on a conventional real estate loan. All right. And then we'll also provide you a business loan, a conventional business loan with no real estate, typically on the 5 to 7 year term. Okay. But the difference, the big difference between the two is typically equity. Okay. You're going to be bringing 25%, up to 25% equity in the real estate, and then you're going to be bringing up to 10% equity in the business. So you're going to be bringing a little bit more equity on the conventional loan than the SBA. But if you are going large scale, or if you're already past your $5 million SBA runway, then you're probably ready for that. And it makes sense to scale into a more traditional loan.
Yeah, it makes so much sense. It's so good. Because, I mean, I think we're used to, like you said, on the consumer side, we're used to a conventional loan. But, man, SBA makes so much more sense. Number one SBA lender in the United States. That's massive.
Yeah, it's pretty. I mean, you think about the number of people we have compared to some of the larger banks, it's pretty neat, right? I think it goes back to that verticality and focus that we talked about in earlier episodes that has helped us accomplish that.
That's so good. All right. Okay, so the other side of, what we've kind of been focusing on is more that one rooftop, two rooftops, a little bit of expansion. What if I'm wanting to buy 35, 40 rooftops? Big expansion, big plans. What give me some insight there.
Other characteristics start to matter a little more.
Okay.
One of those is leverage. And leverage is pretty simple when you break it down. It's really your total debt divided by your total EBITDA, annual EBITDA of the business. We usually take an average. For funeral service, we like to see a leverage ratio below 5.5 times, meaning that we're comfortable with the amount of debt you have compared to the amount of net operating income you have. Okay. That's why in earlier episodes I talked about how high leverage can be dangerous, because when you get into a conventional lending relationship with a bank, it's going to matter and it's going to bite you. Okay. That's also why you see a lot of equity players with big buying groups, is because they are balancing the amount of leverage that they're exposing themselves to. It makes sense?
Sure.
They would rather give away equity early to take advantage of an opportunity with moderate leverage than to lever up quickly and be done.
Sure.
Okay. So leverage is big. Very big. The other component to actually the bigger buying groups, I mean, it's important to work with the bank and understand the expectation of how much they'll lend on an annual basis of exposure, because they're taking on that exposure. So you got to have a strategy. You can't go in and assume that you're going to get $100 million in 2 years. Okay. You got to have a balance there. But it's also having that local ownership presence. Because if you're buying all over the place, the bank is going to want to see that you have somebody that is representing the office and the vision of the business in that location that is also licensed.
Yeah.
Right. And some would call that a key employee. Right there. That person is responsible for satisfying the licensing requirements, but they're also spearheading the business for success. And when you start getting really big, that model starts to matter, especially to us, because we know it works. Okay. And then last, I'll say proof of concept. So when you think about big conventional loans, the loans are pretty simple. You're going to have a standard 5-year balloon, 20-year AM on the real estate mortgage. You're going to have a 5, 7, or 10-year term on the business loan, okay, depending. And then as you grow, you're going to have some covenants to maintain certain parameters and KPIs for the business. But it's really important to understand that in order for you to get to a point to where you have a full credit facility, you're giving a lot of freedom to go out and buy with our capital. It's going to take time and trust building before we reach that point. And I think that's an important expectation.
That's good. That's the relationship component.
It is.
I like that. Okay. Just to wrap up this conversation, part one, what are some characteristics that you look at for a loan like that we should be paying attention to? Terms, fees, interest rates, what are some of those things that...
Yeah, absolutely. I think in terms of just breaking down the term, your SBA loan is great because if it's a majority real estate, you can get up to a 25-year term. No real estate is going to be a 10, and then weighted average is typically 15 years. So it's great. Conventional, again, you're going to have that 5-year balloon, 20-year AM. And then on the business conventional loan, you're going to have a 5 or 7 or 10-year term. But I think in terms of rate, we price our SBA and conventional pretty closely. It's pricing is more about not only the size, but the quality, the characteristics of the loan, the risk. We take all that into account when it comes to pricing. And on that topic, pricing, that's kind of a whole other segment. But, pricing is something that you've got to consider is going to be different for every organization and institution. But it's just like we say, you get what you pay for.
Sure.
So you can get a better price, but you might not get the consultative approach and the industry expertise to go with it. And so be careful just going for the cheapest rate.
That's so good. And I mean, those are some of the things that we've talked about that Live Oak offers on other episodes of the strategy and the consulting, and just really making sure that the business owner and the buyer or the seller are getting the right deal with the right options. So.
Yeah, and we feel very consultative, and we certainly farm out a lot of consulting work to a lot of the consulting partners in the space. We don't overlap that, but we do provide a white glove service that goes a lot further than just giving money.
Sure. Love it. All right. There you go. That's part 1 of everything you need to know about business loans in 2024. And you can take that to the bank.